You have a savings account. Maybe you have had one since you were a kid. A parent sat you down, explained that saving was smart, and you believed them. And they were not wrong exactly. But they were missing something enormous, something that banks understood for centuries before you were born. Something that, once you see it, changes every financial decision you will ever make. The advice you got was incomplete. And incomplete advice, when it comes to money, costs you a fortune. Here is what nobody told you. Money sitting still is money moving backward. Not because of some abstract economic theory, because of a force so constant, so invisible, and so mathematically ruthless that most people never even feel it working against them. That force is inflation. And the savings account you were told to trust? It is one of the least effective tools ever invented for fighting it. The average high street savings account in the United States pays somewhere between 0.01 and 0.5% interest per year. Inflation, historically, runs at around 3% per year. That gap, that silent, invisible gap, is the hole your money falls through every single year you leave it sitting there. Economist Irving Fisher described this relationship in 1930. He called it the real interest rate. The actual return on your money is not what the bank pays you. It is what the bank pays you minus the rate of inflation. Do the math. If inflation is 3% and your savings account pays 0.5%, your real return is negative 2.5%. Every year. Without fail, without drama, without anyone telling you it is happening. You are not saving. You are slowly losing. But here is the part that should genuinely shock you. This is not a flaw in the system. It is a feature of it. Banks have known this arithmetic for as long as banks have existed. The savings account was never designed to make you wealthy. It was designed to make you feel safe while your money worked for someone else. When you deposit money into a savings account, the bank lends it out at 7, 8, 10, sometimes 20% interest. They pay you 0.5%. They keep the difference. You take the inflation hit. And everyone smiles and calls it financial responsibility. So if savings accounts are broken, what actually works? To answer that, you need to understand what money really is. Not coins, not paper, not numbers on a screen. Money is a claim on future productivity. When you hold money, you are holding a promise that someone, somewhere, will do work or create something of value in exchange for it. The question is never whether to hold that promise. The question is what form that promise should take. Benjamin Graham, the economist and investor who mentored Warren Buffett, spent decades studying this question. His conclusion was stark. Assets that produce something, companies, real estate, productive land, tend to preserve and grow purchasing power over time. Assets that simply sit, cash, low-yield savings, mattress money, tend to erode. Not because of bad luck, because of mathematics. The stock market, over any 20-year window in modern history, has returned an average of roughly 7% per year after inflation. That is not a guarantee. But compare it to the negative 2.5% real return of a savings account. The gap between those two numbers, compounded over 30 years, is not a rounding error. It is the difference between retiring with dignity and working past 70. Here is a number that will stay with you. If you put $10,000 into a savings account paying 0.5% for 30 years, you end up with around $11,600 in nominal terms. But in real terms, adjusted for 3% annual inflation, that money is worth less than $5,000 in today's purchasing power. You followed all the rules. You saved diligently, and your money got cut in half. Now run the same $10,000 through an index fund returning 7% annually for 30 years. You end up with roughly $76,000 in nominal terms. In real terms, that is around $31,000 of purchasing power. Same starting amount. Same 30 years. Completely different outcome. The only variable was where the money sat. Vanguard founder John Bogle spent his entire career trying to explain this to ordinary people. His argument was not complicated. The market, on average, beats inflation. Fees and inaction are the enemy. A low-cost index fund, bought consistently and held patiently, outperforms nearly every other strategy available to a non-professional investor. Not because of genius, because of time, and because of compounding. Compounding is the concept your savings account pretends to use but does not actually deliver at a meaningful scale. Compounding means your returns generate their own returns. Your gains earn gains. Your money multiplies itself. Albert Einstein reportedly called compound interest the eighth wonder of the world. Whether he actually said it or not, the math is undeniable. At 7% annual return, money doubles roughly every 10 years. At 0.5%, it takes 144 years to double. Your great-great-grandchildren might see that double. You will not. But here is where it gets more nuanced. Because the answer is not simply to never have a savings account. Liquidity matters. Emergencies happen. The money you might need in the next 3 to 6 months should not be in an investment account. Markets go down, sometimes sharply. If you need to sell at the wrong moment, compounding works against you just as powerfully as it can work for you. The real lesson is not that savings accounts are useless. It is that they have been wildly misapplied. They are an emergency fund vehicle, a short-term buffer, not a wealth-building strategy. Psychologist Daniel Kahneman, who won the Nobel Prize for his work on human decision-making, identified something he called loss aversion. People feel the pain of losing money roughly twice as intensely as they feel the pleasure of gaining the same amount. This means that the idea of putting money into something that could go down, even temporarily, triggers a fear response that feels bigger than it actually is. The savings account feels safe. The brain rewards that feeling. And the brain is wrong. The perceived safety of the savings account is itself a bias, a cognitive illusion. You are not preserving your wealth. You are slowly watching it erode while experiencing the emotional sensation of security. The risk you think you are avoiding is exactly the risk you are guaranteeing. Now think about the people in your life who built real wealth over time. Not lottery winners, not inheritance recipients. The quiet ones. The people who started putting money into index funds in their 30s and just never stopped. They did not time the market. They did not pick winning stocks. They did not have some insider edge. They just stopped letting their money sit in instruments designed to pay them as little as possible. They understood something simple. Inflation is always running. Compounding is always available. The only question is which one you put your money into. There is a concept in personal finance called the opportunity cost. Every dollar you keep in a savings account is a dollar not compounding elsewhere. The cost of that choice is not what you lost in the savings account. It is what you failed to gain everywhere else. That invisible cost, multiplied across decades and across every dollar you ever saved, is the real price of following the advice you were given. Here is something worth sitting with. The wealthiest people in the world do not keep their money in savings accounts, not because they are reckless, because they understand the arithmetic. They hold assets, companies, property, stakes in productive enterprises. They let inflation erode the purchasing power of their debts while their assets appreciate. The savings account for them is petty cash. The system was not designed to make savers rich. It was designed to make savers comfortable enough not to ask questions. And for most of your life, if you are like most people, you did not ask them. You ask them now. The question is not whether to save money. The question is what you save it in. Because the account you were told to trust when you were young, it was never the destination. It was the waiting room. And some people spend their entire financial lives sitting in it. Tonight, when you check your bank balance, you will probably feel the same vague sense of security you always have. The number will sit there, stable and familiar. But now you know what that number is actually doing. It is not growing. It is not holding. It is slowly, invisibly, mathematically shrinking. And somewhere in the background, the gap between what you have and what you could have is getting wider every single day. The savings account did not fail you. The advice around it did.